We've got an analysis report that's making a really big claim that Rocket Lab is the next Tesla with a clear path to a $100 billion valuation.
It's a bold thesis, definitely. And it's built on the Neutron rocket and their space systems revenue.
Exactly. So today, we're not going to debate the stock itself. We're diving into how the report presents its data and how we can elevate it from a really exciting pitch into something more robust and credible. Okay, so let's jump right in. The first point is about that energy. I mean, a key theme here seems to be this immediate appeal to FOMO.
Mm-hmm.
It calls Rocket Lab the only company on Earth that is genuinely challenging Elon Musk. A second chance on a silver platter. It even uses phrases like Prince money.
Right. And while that high-energy Miss Tesla framing is fantastic for grabbing a retail investor's attention, the intensity of that bullish tone, it risks undermining the credibility of the data itself.
So the hype might actually be hurting the argument.
I think so. The weakness is that this aggressive focus on hype could alienate more sophisticated readers. I mean, the report has some great objective facts. $1 billion backlog, 48% year-over-year growth.
Those are strong numbers.
They are. But when you wrap those facts in really charged, subjective language, the whole thing starts to sound less like research and more like a marketing piece. And that's a problem for anyone looking for a balanced view before they invest.
Okay, I see that. But if the goal is to reach that high-energy retail crowd, and you strip out all that energy, don't you risk losing them? Trading engagement for rigor?
That's the exact balance we need to find. The suggestion here isn't to kill the energy, but to modulate it. Keep that infectious, high-energy style for the intro and the conclusion. Use them as bookends.
Ah, okay.
But in the core sections, 1, 2, and 3, that's where you replace the emotionally charged language with more neutral, data-driven descriptions. You keep the author's voice, but you seriously boost trust where it matters most.
So formalize the engine room of the report. How do we do that without making it dry?
It's all about precision. Focus on why a milestone matters. Don't just say that it does. So, for example, instead of saying they just completed the Hungry Hippo fairing tests, a huge de-risking milestone,
Yeah.
you'd rephrase it to something like, the successful completion of the Hungry Hippo fairing tests significantly de-risks the Neutron development timeline. You're explaining how it de-risks the project.
That immediately feels more analytical. It shifts from just enthusiasm to technical validation.
Exactly. And you do the same with that only company claim. You can adjust that to something more defensible, like a leading publicly traded US-based alternative with a proven track record.
Right. Let the numbers do the talking.
Let the numbers talk. When the facts are this good, you just don't need the hyperbole. And that subtle shift in language makes the whole analysis feel so much more credible.
And that credibility is key, because the analysis is asking for a huge leap of faith, which I think brings us perfectly to our next point, the structural gap we noticed. It's about risk.
Mm-hmm. As I understand it, the argument is that Rocket Lab can capture, 25% of the market in a duopoly with SpaceX. But the report kind of just ends with this brief note. Investing in space is volatile. It is risky. And that's it. No detail. And that's not enough. To elevate this from a compelling story to a robust investment thesis, it has to proactively and structurally address the huge operational and competitive risks. The weakness here is glaring. It's the complete absence of a structured risk assessment. I mean, a $100 billion target that hinges almost entirely on the success of the 2026 Neutron launch?
That's a massive binary bet.
It's a huge bet. It has catastrophic failure potential, timeline risks, and they're all just ignored. Any professional reader is going to see that and, frankly, might just stop reading right there.
It makes the whole thing feel like it's built on a best-case scenario. No safety netting at all.
None. And what's more, it leans so heavily on this duopoly idea, SpaceX and Rocket Lab, but it doesn't even mention other serious competitors. You got ULA, you have international players, and critically, you have Blue Origin.
New Glenn is a direct competitor.
A direct competitor in the heavy lift space. Ignoring that makes the 25% market share assumption feel like wishful thinking, not a real projection. It leaves the thesis wide open to being dismissed. So, the suggestion is to add a dedicated formal section, maybe right before the conclusion. Title it Key Challenges or Risk Factors.
Okay.
And in there, you list 2 or 3 specific high-impact risks. Neutron delays, technical failure, a major competitor. But, and this is the crucial part, after you name the risk, you provide a concise, data-backed counter-argument using Rocket Lab's own strengths.
Ah, so you acknowledge the risk, but then you immediately mitigate it using their existing advantages. That shows you've thought it through.
Precisely. And to make it concrete, let's take that competitive risk. You could explicitly name Blue Origin's New Glenn, then offer a counter, something like, while competitors are developing heavy lift capacity, RKLB's unique vertical integration with its space system segment provides a financial buffer that pure launch providers just don't have.
That's powerful. You're turning a potential weakness, the competition, into a defense of their specific business model.
You are. And you do the same for technical risk. State the obvious concern. A slip in the 2026 Neutron launch date remains a primary concern. Then you pivot. You show how the fast-growing space systems revenue acts as a financial stabilizer. It's a valuation floor, that exists completely independent of Neutron's success or failure.
That makes a ton of sense. It shows you've anticipated the reader's biggest questions. Okay, so that leads us to the final piece, the numbers themselves, the financial snapshot. It does a good job highlighting momentum, the revenue growth, the cash on hand, the backlog. But the bridge from today to that $100 billion target feels a bit flimsy.
Right. The financial snapshot successfully highlights the current momentum, but it lacks the quantitative link needed to bridge the current valuation to that aggressive $100 billion target. It relies way too heavily on a comparative valuation, and that's the fundamental weakness. The report basically says Rocket Lab could be worth $100 billion because that's just 25% of SpaceX's valuation. But that's not an analysis.
It's a comparison, not a justification.
Exactly. An investor needs to see the actual financial performance Rocket Lab has to achieve to justify that number. What's the required revenue, the free cash flow? We don't see any of that.
And if you only rely on that comparative multiple, your entire thesis could collapse if the market decides to re-rate SpaceX, right? It has nothing to do with Rocket Lab's actual performance.
You got it. The company needs to justify the valuation on its own merits. Oh, and on a smaller note, there's a confusing point in there. It's not clear how the $55 stock price relates to a $30 billion valuation that's mentioned. Is that current? Is it a projection? That kind of thing needs to be crystal clear. So the suggestion is this. The report needs to dedicate a subsection to defining the required financial path to get to that $100 billion milestone. This is critical. It shifts the whole focus from a relative valuation to a fundamental one. It answers the question. What does this company actually have to earn by 2030 to be worth this much?
So, is the connection between today's numbers and the big target fully established? It sounds like that's an area to really bolster. You need to show the math.
You have to walk the reader through the math. For instance, you could model it out. If Rocket Lab reaches $5 billion in annualized revenue by 2030, then achieving a $100 billion market cap would require the market to assign it a 20 times price-to-sales multiple.
Okay, but 20 times sales is aggressive for an aerospace company. So you can't just state that multiple. You have to defend why they deserve it.
And that's where the unique part of the thesis really gets to shine. You have to explicitly justify that premium multiple. This is where the whole Foxconn of space idea becomes so powerful.
Because of the space system side of the business.
Exactly. You quantify the higher margins you expect from space systems, and you argue that that part of the business deserves a higher, almost software-like valuation. That pulls the whole company's blended multiple up. That's what differentiates them from a pure lower-margin launch company. Showing that level of quantitative rigor, it completely transforms the report.
Okay, that really ties it all together.